Not seeing me or hear me. Hopefully someone will throw something at me. Let me know.
Looks good, John.
Perfect. But I appreciate you all for taking the time. I'm assuming all of you clicked on the link that said Cotton and Coffee this morning. I hope you read further enough down in your invite to see that this is going to be an economics presentation, that you did grab some of the extra strength coffee this morning. I do have a full set of charts and graphs for you guys to look at, but of course there's been a lot of excitement in the market, and hopefully we'll keep you guys all dialed in. With that, I'm gonna go ahead and get started. Start by just taking a look at a price chart. Here we've got December futures going back to January of 20. So essentially going back before the onset of COVID. What you notice is that we did have some very friendly price movement during much of the time period covered here. Cotton prices, including December prices for the current crop year, had pretty linear, pretty controlled movement there. We had a period of about a year and a half, where cotton prices bounced off their lows that were down, in the 50s. Two levels getting up to 90 cents per pound before things started getting a lot more exciting. Once we got into September of 21, we started to hear some things about the Fed about potentially dialing back on the monetary supply, but that didn't affect commodity prices. It didn't affect cotton prices during that time period. What we did see was some increased spec involvement. So we had this period of relatively controlled price movement. Things got a little bit more erratic, and we did see some higher concentrations of spec participation in cotton futures. We pull out a couple of other events in here along the way. One of them, of course, has been very important, is the outbreak of war in Europe. Initially, that pulled prices lower for cotton and also some other commodities. But I think once people started thinking about, competition that cotton might have with acreage for other crops, that helped pull us a good bit higher. Of course, we did see our nearby prices top out at levels around 150 here for our new crop December. We didn't see them quite get so high. When they did form that peak, of course, it wasn't very long lasting. We did see a broad sell-off in commodities occurring back in June and July, which took a lot of wind out of our sales, took us back to about 90 cents per pound, which is where we were before we saw specs really get involved back in the fall of last year. More recently, the prices continue to be extremely volatile. We made up most of that ground when the USDA unexpectedly dropped their crop forecast by about 20%. So when the USDA transitions from July to August, there's an interagency shift in terms of who's making the US crop number that appears in the WASDE reports. With that shift, we did see a big change in expectations of the numbers. Of course, weather conditions hadn't been very favorable. Everybody was expecting a little bit of decrease, but instead of that being feathered in, it all came in one shot, and that sent the market a lot higher. More recently, we've had some downward price movement. Somewhat interestingly, this correction that we had, which is the steepest part where that line's pointing to right there, that coincided with the same week when we had news about all the flooding occurring in Pakistan. So despite the fact that some of the world's cotton, was getting wiped off the books, we did see cotton prices move lower. A reason for that is, of course, nothing occurs in isolation. So even though we did see this flooding happening in Pakistan, we also had some news come out on the macro front. We had Jerome Powell saying that he was going to stand by interest rate increases. He was going to be there to increase interest rates as long as inflation remained a threat. There was a lot of news out of Europe during that time period, a lot of concern about how severe the pinch might be on their budgets, given the increase in energy costs as everyone looks ahead to the winter time. And then also, even in China, there's some news about slowdown as well. So take a look at our major consumer markets. There was some concern there. The market does seem like it's been paying a lot of attention to macro factors or factors associated with the Fed recently, and that pushed the market lower, even though we did have that flooding in Pakistan. Then, of course, in the cotton market, if you haven't been paying attention today, you're already out of date. We've had some more corrections occurring in the cotton market here just over the past few days, with prices sliding back below $1 per pound. So an extremely volatile market out there. Price levels still near $1, but of course not as high as probably as anyone would be hoping, and maybe not as high as anyone would expect given the tightness in the U.S. balance sheet. So we'll sort of walk you through all that, but certainly a very, very busy global cotton market right now. And something I think is very important to point out is that it's been a very busy world for the past several years. There's been some major shifts, not only in the global economy, global political economy, just the world in general. There's been major shifts. If we can rewind the clock a little bit, and something people forget about, but there is a trade dispute that started with U.S. and China going back to 2018, 2019. We're talking about the world's two largest economies making a shift from what had been, decades moving towards increasingly free trade. Now we're moving to a more regional system and a separation of two of the world's largest markets. So, in normal times, this would be a very earth-shattering event. This would be one that would still be regarding headlines down the road. But of course, we've had other things happen since then. We had COVID, we had lockdowns, causing major shocks to the global economy. If you just take a look at the U.S. GDP numbers, these are our top line numbers, our highest level numbers. We had back-to-back 30% decrease in the annual rate of GDP growth with COVID. And then after that, we had a 30% increase. So a huge volatility in our most aggregate economic numbers. So big shocks that are out there. Of course, we had stimulus after COVID that led to a spending surge. So, to combat fears of economic collapse, we had unprecedented stimulus that U.S. consumers in particular have showed up in a big way, supporting the economy and supporting a lot of our businesses. But the bad thing is yet, when all this was happening, we also had the shipping crisis going on. So consumers wanted goods. It's hard to get them there. That difficulty in getting goods where consumers want it, supply not keeping up with demand can lead to price increases. We've certainly seen those. Numbers everybody watches pretty closely is what's happening at the pump. Something else that hasn't happened relative to energy prices, of course, is the war in Europe. Another major shock to the global economy, adding to that regionalization that was set into place between the U.S. and China just a few years before, with Russia no longer being able to ship its energy to the markets as it normally would. Then to push back on inflation, already touched on how the Federal Reserve has been influential on cotton price direction. We have had a period of higher interest rates after a period of very stimulative monetary policy going back all the way to the financial crisis for more than a decade. We're now seeing interest rates having to be increased very rapidly to catch up to inflation. When we do see higher interest rates, that means slower economic growth. Slower economic growth tends to mean slower demand for cotton. So you take a look at all these events, maybe seem a little long-winded in the discussion already, but this is all had just happened over the past 4 years. So these are major developments that have all been crammed in just a 4-year period. So a big shock for us, obviously, in the cotton market. But you think about some of your companions on the cotton board on the import side, all of this represents a significant headache for them. When we take a look at people that are insourcing, which will be a lot of the importers that are on the board, they typically place an order for goods that will arrive 12 months later. So you take a look at these events. Once again, they've occurred over the past 4 years. But within that, you think about you're trying to plan for shipments that occur 1 year later. By the time you probably push the button to place a multi-million-dollar order, the world may have turned on its head and had another major shift. So here we take a look at what some of these effects could be for cotton supply chains. When you see the trade dispute, not only are U.S. and China the world's largest economies, they are the world's largest top trade partners for the cotton supply chain. U.S. is the world's largest exporter of cotton fiber. China is the world's largest importer of cotton fiber. The U.S. is the world's largest single market importer of apparel. China is the world's largest exporter of apparel. We'll take a look at what happened with COVID. Of course, it came out of nowhere, was a big surprise. When that happened, orders were slashed. A lot of manufacturers in our developing markets were concerned about how to support their employees during this time period with Western brands walking away from some of their orders simply to try and preserve cash and stay in business. Not long after, we saw orders surge. So after mass cancellations, we saw mass order placements. Reason for that is that, pipelines get cleaned out during recessions, preserve cash, stay in business. The strength of consumer demand that followed was pretty unexpected. So a big shock there on the demand side. Making matters worse was a shipping crisis. So you needed things in a hurry to try and keep up with the consumer while they're spending. Hard to get goods there when you wanted to. And then, as goods started to flow, as the shipping crisis potentially started to ease, or as you started to adapt to the shipping crisis, we had inflation rear its head. So consumer dollars getting pinched from many directions. The war in Europe just made that worse. And then on top of that, we've got inventory accumulation as the global economy starts to slow. So a lot of major events out there in the world affecting, representing major shifts in the global economy, causing very significant shifts and very rapid shifts in the demand placement throughout the global cotton supply chain. So cotton prices are getting whipped around, but the world's been getting whipped around, and certainly cotton supply chain has been getting whipped around as well. So to try and boil all these things down, I think we really do have two conflicting storylines pushing and pulling the market right now. Some things we've already touched on, more tied to the demand side. We've got inflation, rising interest rates, slower economic growth. One of the best predictors we have for changes in global mill consumption of cotton are rates of global GDP, and those have been shifting definitively lower here over the past several months. Meanwhile, we also have supply concerns. Here in the US, of course, we've had severe weather issues. We've also had weather issues develop, particularly in Pakistan here recently. So there is some concern about tightness in supply, particularly concerns about tightness in exportable supply that could be pushing the market a little bit higher. So we have these two stories. During certain time periods, one dominates, the other one dominates during other certain time periods, contributing to all this volatility that we've been experiencing. Throughout the remainder of the talk, we'll cover both demand and supply. We'll start by taking a look at some of the arguments from the demand story. Here we have global GDP. The gray bars represent economic growth at the world level that has been estimated for previous years. This is just to give you some context about where we are, where we're expected to go relative to where we have been. Barry, when he shows these numbers, he's always very good about pointing out, if we have economic growth somewhere around 3%, that's really just sort of treading water. That's not really enough to move the needle on cotton consumption growth. If we do want to see demand move higher, we need to see demand move up and above that 3% level. You can see you had some reasonable growth leading up to where we were before COVID. Things were slowing down in 2019 with the trade dispute. COVID hit, and you see a negative number here in terms of global economic growth. It's relatively rare that we have a global contraction. See very strong growth with stimulus in 2021. And then here we can take a look at estimates for the current calendar year and also for the upcoming calendar year. Of course, the 22 and 23 calendar years will straddle the 22-23 crop year. These light blue lines show the estimates that the IMF released in January, similar to the USDA. When the IMF gets new information about what's going on in the world, they'll revise their forecast for global GDP over time. They do this about every quarter. So here's the estimates where they had at the beginning of the year, which was before the war in Ukraine. They were expecting there to be pretty strong follow through from the really strong growth we had in 2021. This growth of 4.4%, obviously the strongest that we would have experienced outside of the immediate rebound here in recent history. But given the war in Ukraine and the flaring inflation in the US and around the world, we're seeing those growth expectations getting revised pretty significantly lower. So we went from 4.4 to 3.2, and I think we'll probably see that number come down as we get to the point where we start to close out the 22 calendar year. Once again, lower economic growth translates to slower mill demand. Taking a look forward to the 23 calendar year, the IMF is predicting growth will be slower than it was in 22, down at 2.9%, which matches the slow growth that we had back in 2019. and also down significantly compared to where they're thinking in January. So estimates for these highline numbers that are tied to global consumption growth, they've been getting weaker over time. And I think there is downside risk. We may see these numbers actually move lower as we get further into the future and as inflation and higher interest rates are more fully digested around the world. The change in the outlook for the global economy, I think, was a factor that contributed to the commodity sell-off. We did see a lot of specs come into the market in the fall of last year, and we saw a lot of them decide to get out in June. That, of course, pulled cotton prices lower. You take a look at the values between early June and early July, cotton prices dropped by about 25%. These are referring to new crop prices here. They're a little bit steeper for nearby prices. But cotton was not alone. So corn's down about 15%, soybeans down about 15%, wheat down over 20%. So see a lot of specs getting out of ag commodities, but we also could extend the declines to take a look at losses in industrial commodities as well. Copper, which is associated pretty heavily with changes in global economic growth or the global economic outlook, was down about 20%. And then also crude oil, which is also tied to growth expectations, down more than 10%. So, this decrease happened, it hurt, but maybe, we weren't alone. So that's the thing. It wasn't anything unique to us here. It was a macro sell-off affecting the commodity sector at large. But there also is some good news out there on the demand front. I think, something that has been really supportive of the market recently has been the growth in spending here in the U.S. U.S. consumption has increased pretty dramatically since COVID. The stimulus dollars helped a lot getting consumers spending more, and they have been spending more on clothing. So here we've got a chart showing you what U.S. consumers are spending on clothing. You can see, of course, the big shock that we had with the onset of COVID. We also can see the very strong growth that we had once stimulus started to work its way through the economy. We take a look at spending on clothing. We're up 25% relative to the same month where we were back in 2019. When we did see the spending growth occur, it hit a lot of retailers by surprise. Here's the inventory sales ratios. This is the volume of everything that retailers hold for clothing stores. In inventory, in the back room or also in their warehouses, divided by their sales volumes. So you see when consumers stopped spending during COVID, we saw a big spike in inventory. Since then, you can see that as consumers started spending more, we saw this ratio move a little bit lower. But unfortunately, it has been trending a little bit higher here more recently. So this is what I want to talk about is what's going on with the inventories here. So retailers have been playing catch up with consumers over the past year and a half. But I think we're at the point now where they need to be concerned about maybe bringing too much in. One of the reasons we can say that is by taking a look at the volume of U.S. imports. So this is the U.S., the volume of cotton contained in U.S. apparel imports. And you can see that it certainly has been surging. It takes a while to catch up. Once again, when retailers place an order, it takes about a year for those goods to show up in ports. So this big surge that we're seeing in import volumes that is still happening right now is a reaction to the big growth that we had in consumer demand that occurred about 18 months ago. But the problem is, once again, we talked about these major events hitting the market, and we've got this big 12-month lag in reaction among retailer demands, is that when we do see this import volume, which is now for around 18 million bales relative to 13 million bales where we were before COVID, is that we're getting hit with a slowdown at the same time. So you guys have probably seen these headlines out there. A lot of our major retailers have suffered in terms of their stock prices due to inventory concerns. So stores have too much stuff, get ready for discounts. When retailers discount, it means lower margins, which could mean lower order placement down the road, cancellation of orders ahead of the holiday season, need to offload inventories, once again, cutting inventories. A lot of inventory concern out there, which could mean lower order placement as we look ahead, to the next 12 months of imports that are coming from our retailers. Here's something else that's affecting some of the dynamics related to consumer spending. We've got different broad categories in spending out here. The blue line is showing spending on goods. So this is goods for, this includes clothing, also includes anything else that you may be storing in your house. With the stimulus, we saw very strong growth in goods relative to services. So services, that'll include things like restaurants, also include spending on things like going to the doctor or the dentist, which people were doing less when we were suffering under the COVID months. But now that the pandemic has been starting to lift, we're seeing some returns back on the service side of spending. If we do see consumers shift their spending back towards the services side, that could mean less dollars going to goods, which could mean some pullback in terms of the spending that we're seeing here on clothing. Here's just a breakdown to give you an idea about where consumers spend their dollars. The bulk of the economy comes from service sector goods, about 40% of overall consumer spending. So just give you an idea about where these percentages are. And the reason I wanted to do that also was to sort of set you up for different categories within spending as well. So you want to take a look at where consumer dollars go. We've only got about 2% of consumer budgets going into apparel. Big proportion going into housing, another big chunk for food, smaller chunks for utilities and gasoline, but of course these are tied to energy. The reason why I've got these called out in green as opposed to gray is because I want to highlight some of the volatility in prices for these consumer spending categories to give you an idea about where consumers are being pinched most by inflation. You want to take a look at inflation specific to clothing prices or the clothing market. We haven't seen a lot of really strong inflation in apparel. We have seen some year-over-year growth, but the reason why we've seen very strong year-over-year growth is because the apparel prices at retail decreased about the most that we've seen for any spending category with the onset of COVID. So when COVID hit, we saw a big accumulation of inventory among retailers. They had to drop their prices to keep consumers interested in buying clothes. That meant a big decrease in clothing prices. So that means that we have seen some pretty strong year-over-year gains in apparel prices. But if we can compare overall price levels relative to where we were before COVID, we're only up about 2%. So not too bad, particularly not too bad compared to some of the increases we've seen in these other spending categories over here, which take up a lot more of consumer budgets. So clothing prices up about 2% relative to where we were before COVID. Housing prices up about 15%. When that's representing about a third of your budget, that is going to put a pinch on consumers. Food prices up about 20%, utility prices up by about 25%, and then of course gas prices up a lot more than everything else. But when we put these pieces together, once again framing this in terms of the cotton market discussion, is that consumers are feeling the effects of inflation that can lead to lower spending on apparel, but the effect or the impact of inflation is not coming from apparel itself, it's coming from these outside sources which have had a lot more volatile prices. It's not higher clothing prices cutting back on clothing spending. It's higher prices for most other things that have a lot bigger budget share that are probably going to affect how much consumers want to spend here in the US. But of course, we're a global cotton market. Inflation is global. You want to take a look at some of our other big consumer markets for cotton or for apparel. Of course, one of those is Europe. Europe collectively consumes about the same amount as us in terms of end-use consumption or consumer demand. News that was coming out at the same time that we had the flooding in Pakistan were figures saying that European utility costs should triple relative to where they were last year in the coming winter months to about $500 to $600 per month. Of course, if we saw, our utility bills go from $150 to $500 per month, that's going to cut back probably on how much you're going to be spending on clothing. We take a look at some of our more developing markets. They have a much higher share of their budget that goes to food. So China has some price controls which will help mitigate effects, particularly as it relates to energy. But for their food costs, their food represents about 1/3 of their budget over there. So any inflation on the food side is going to have a big effect on consumer markets that are further back on the development scale, such as China. In addition, emerging markets also have significant exposure to inflation. In addition to everything that's going on out there in terms of movements with inflation, movement in commodity prices, a lot of these emerging markets have also seen very significant movement in their exchange rates. These countries tend to have all their debts expressed in US dollars. So if you see your domestic currency collapse and you're owing interest payments, those interest payments get a lot more expensive in dollar terms. What that should mean is slower economic growth from the developing world, where we have been seeing some growth in cotton consumer demand in recent decades. It's all to say that we do have global concerns due to inflation on demand side. But we've got competing forces out there. So hopefully not too much of a downer in terms of covering what's going on demand dynamics in the cotton market. Let's talk a little bit about supply. Of course, supplies are very tight here in the US. And we do have weather issues here. Something that's been a little bit lacking, I think, from this discussion in terms of the headlines that are out there. The global production is still expected to be up year over year. Some of the reasons for that is that we do have the economic responses to the high prices that we had last crop year. Here I'm showing you some historic data just to give you some flavor about what generally happens when we do have prices move over $1 or move well over $1. If we go back to the price spike in 2010, 2011, we had record prices, at least in current dollar terms, brought about a record surplus in cotton in the cotton market. So we saw a big increase in acreage around the world, growers trying to capture some profits from those higher cotton prices. And then we also saw a pullback in terms of mill demand. So we did have a big surplus that emerged there, but we just want to highlight the economic effects where we did see higher prices pulling in higher acreage. We take a look at where we are in recent history. We can see that there has been some volatility in global cotton production. We did have a big surplus in the COVID year. It was about 17 million bales. This is the second largest surplus we have on record, only second to the one that we had after the previous price spike. Since then, we have had some deficits. In the 2021 crop year, the world grew 10 million bales less than it consumed. So that meant a reduction in global cotton stocks. In the crop year that just ended, we had a deficit of about 4 million bales. If you guys could do some quick mental math, you can see 17 minus 14. We're still net positive compared to where we were before COVID in terms of global stocks. But then for the current crop year, we do see a little bit of growth year over year in global cotton production. Do see a little bit of a decrease in global mill use. I think we'll see these numbers change over time, particularly on the demand side. I think there's some room for the global demand number to come a little bit lower. Here's just where things have been going in terms of global dynamics leading into some of our supply discussion. But before we get too close to that, I want to briefly review what's going on the demand side. I just want to take a look at globally. The USDA right now is forecasting only about a 1 million bale reduction in global mill use. Some of that's a reaction to higher prices, some of that slower economic growth. I think we probably will see that number continue to be revised lower as time goes on. USDA does have some numbers I want to call out here. In terms of China, they're saying they'll have about 500,000 bales of additional consumption in the current season. I think there's a lot of reasons to question that, given some of the things that are going on in China, particularly as it relates back to sourcing. On top of that, also Chinese economic growth has been slowing as well. Most other markets essentially flat, some lower use in Pakistan to a smaller crop, some small growth in markets like Vietnam. But generally, I think very mild year-over-year change forecast by the USDA. And I think all these numbers have some risk to being revised lower as time goes on. Here we take a look at the supply side. Globally, the USDA is predicting the world to grow about 3 million more bales year over year. The biggest addition at the country level is expected to come from India. There are some potential concerns about India related to the weather. Northern India has gotten some of the wetness that they did have in Pakistan, so some potential issues there. Something else to always watch in India is the threat of pest infestations. There is some resistance over there in India, and it makes things relatively uncertain, but it's still pretty early right now to know whether or not that's going to happen. India did have a decent increase in acreage given higher prices. Indian prices have been some of the strongest around the world. That's leading to additional production over there. In China, not much of a change in acreage. Weather has been okay, a little bit of an increase in production. We stand out in terms of being a reduction there, with our production now expected to be down about 3.5 million bales. This is up from what the USDA was saying. We're expecting about a 5 million bale decrease if we're going to look at our August numbers versus our September numbers. Brazil expected to grow a little bit more. Australia expected to grow a little bit more. Both these countries expected to produce record or near record crops in their current crop year. Pakistan expected to be down about 500,000 bales. The USDA estimates for Pakistan are a little bit more conservative relative to what we've seen from some of the other numbers that are out there getting headlines. USDA month over month reduced their Pakistan numbers by less than 1 million bales. What I'm showing you here is year over year numbers, but a month over month, pretty mild, less than 1 million bale reduction there. Of course, we wish everyone well, but if Pakistan does have a tougher crop, that does mean potential additional export opportunity for us. Pakistan has been in the top 3 or 4 export destinations in recent years, and probably can expect it to continue to be so in the future due to their ongoing production problems. Elsewhere around the world, just slight increases in production are expected. But something I think is important to point out is that, U.S. growers, you guys are very responsive to relative prices due to the strength of prices last crop year. Planted acreage expected to be up 23% year over year. So a pretty healthy bump in terms of acres planted. But of course, acres planted only matter so much. You have to consider the weather. Somewhat conveniently, the current acreage harvest number is down 23% year over year. So plus 23, minus 23 there. Of course, representative of very tough conditions that have been out there for the past several months. Here's how things look in the balance sheet. Of course, it stands out when we get wet moisture in West Texas or not. When we do have good moisture, we can get a crop near 20 million bales. When we don't have good moisture, we have a crop more around 15 million bales. And we've been back and forth in recent years. For the current crop year, you take a look at our production estimate around 14 million bales. That's going to come up short of U.S. demand. So if we add U.S. mill use to exports, we are going to have a production deficit. That means tighter U.S. stocks, and that can mean some support for prices. Here we have just U.S. stocks numbers, and we also have U.S. stocks to use. You want to take a look at the current estimate for U.S. stocks. You can see that they are tight, but there are levels that are pretty close to where we've been in the recent past. Same story for our stocks to use ratio. So if we take our ending stocks and divide by demand, you can see we're going to be around 18% as the current USDA forecast, which is relatively in line with some of the tight years that we have had in the recent past. You want to take a look at what that might mean for prices. We have been a little bit all over the map when we have had tight U.S. stocks. Of course, in 2010, 2011, we had very strong prices, a little bit weaker, and the 13-14 crop year, weaker still. One we got to 16-17, 2021. Last year, we were at 118 in terms of crop year average for New York futures. And then for this year, we'll see. We've got these two arguments on both sides, weaker demand, but also tightness in U.S. supplies. When we do have tightness in U.S. supplies, we tend to see prices, 70s, 80s can add several cents per pound relative to where we'll be relative to where we would have been otherwise. So I think, it is supportive, but are we going to have prices that are strong or anywhere near the neighborhood that we had last year? We'll just have to see how things pan out. In particular, we need to see how the rest of the world, how aggressive they may be in terms of trying to secure our supplies on the export front. And to get into that discussion about the export front, I think we need to pay attention to where prices are out there in the rest of the world. The market has been flipped on its head here just over the past few months. The CC index, if you're not familiar with it, nothing too complicated, stands for the China Cotton Index. It's a price for Chinese grown cotton delivered to Chinese mills. Traditionally, due to protections that the Chinese government has in place, the China Cotton Index is 15 to 20 cents per pound higher than the A index. A index is our international export price. It gets cotton to ports in Asia, including those in China. But if you take a look at current Chinese prices, they're around 100 cents per pound. These are well below the A index, which is now at around a 120. So instead of having a 15 to 20% premium relative to the A index, Chinese prices are now below the A index by 15 to 20 cents per pound. And Chinese prices are currently trading near the ICE futures prices. A price that tends to trade close to our futures prices is Indian prices, but they've been the most expensive for some time. Just a few weeks back, there's as high as 150. There has been some decreases there. They're now around 130. So some big changes in global price dynamics. If you can bear with me on this chart, this is a good example of spaghetti soup that they tell you not to present when you're in economics classes. But we need to show all of these, I think, prices on a single chart. So these are international cotton price benchmarks. You can see most of our benchmarks tend to trade pretty tightly with one another here. The one that stands out is our Chinese cotton price, which is here in red. You can see that our Chinese cotton prices dip below our other prices just a few months back. In terms of indicators for price reversals, when we have had price spikes recently, so I'm including last crop year and then also 2010, 2011, both times immediately preceding the decrease that we had in our international prices, we did see Chinese prices fall below the A index. So we're 2 for 2 in terms of recent history with the Chinese price indicator or Chinese crossing indicator, giving us a heads up when world prices need to decrease. But here's just a better view. You can see, more recent history. So this is going back from last crop year through to the present. You see, once again, most of the time, Chinese prices are higher. Chinese prices started dropping lower in the spring months. And right now, they're some of the lowest prices that are out there. Indian prices, once again, currently being the most expensive. But you may be asking, why does it matter? Well, it matters for several reasons. First of all, it's reflective of something that is going on in the Chinese market. There's a lot of inventory in China. And within China, cotton flows from the grower to gins. Gins then possess that cotton and can sell it downstream to a merchant or to a mill, meaning that gins make purchases and they are in possession of cotton. So they buy seed cotton and they hold bales. When they sell those bales onward from the gin, there's a lot of price disagreement last year. The gins wanted higher prices and the mills were willing to pay. There's a standoff situation for much of the last crop year. And the end result was that gins are saddled with a lot of inventory. Current estimates are that Chinese gins are sitting around 10 million bales of cotton in warehouses. So there's a lot of cotton within China just waiting to move. When it does move, it'll probably be at a loss for gins over there. But that cotton does exist. Something else to point out here is that not only is China sitting on a lot of cotton, not only are Chinese prices a little bit lower, but China is the world's largest buyer of cotton fiber. They represent about 1/3 of global spending. In recent years, they represented about 1/3 of our exports. On top of that, China is the world's largest buyer of cotton yarn. Vietnam supplies China with about half of its yarn imports. And of course, Vietnam is a very important customer for us as well. When you do see lower prices for Chinese cotton, it means that it's more profitable for them to use what they have. They have a lot of inventory there. They could try to burn that up instead of importing fiber from abroad. And that applies not only to fiber, but also for yarn. So when you take a look at spinning mills and when they're making yarn, the largest piece of that price pie when they're making yarn is fiber. So instead of having a cost disadvantage, which they traditionally do in China, which has led them to import more yarn, they have a little bit of a price advantage right now with prices being lower domestically. We can take a look at some of the effects there in terms of fiber. We've seen imports down year over year for 12 out of the past 13 months in China. This represents a 5 million bale loss in terms of global import demand. And then we take a look at yarn. Imports of Chinese yarn has been down in each of the last 9 months, and this represents a loss of 2 million bales. So these are pretty big numbers, 5 million bales, 2 million bales, that's 7 million bales. We add them together. Chinese government policy is always uncertain. We don't know what's going to happen relative to Chinese reserve buying. That's something that has been supportive of our export sales here over the past couple of crop years. If they decide to bring in more imports or more quality fiber to help boost the qualities in their reserves, that could be something that could help. But if we were looking at market dynamics alone relative to the Chinese cotton situation, they're not too supportive right now. Another complicating factor is that Western bans on Chinese cotton fiber content are slowing demand. So in addition to there being a lot of inventory in China, there's also some decreased demand, particularly that for the export apparel market or the exports of finished goods. Right now, the only bans at the country levels that are out there are in the US. But with the UN condemning forced labor in Xinjiang recently, I think that's given the EU room to implement their own bans. And there has been some noise that they may potentially move to make official bans in Europe as well. So if and when that takes place, that could be another factor contributing to weakness in demand within China. The counterpoint could be that if Chinese manufacturers are doing a good enough job in terms of their traceability, and they are able to sufficiently prove that they're not using Chinese cotton or any cotton that potentially comes from Xinjiang, that could be something that supports their imports of fiber from abroad, given that it would not be involving any forced labor. So we got some competing forces out there. We talked about these on the demand side. Of course, a lot of concerns about inflation, rising interest rates, slower economic growth around the world, how that could pull back on consumer spending and manufacturer demand. In terms of supply side, a lot of tightness in US supply, tightness in global exportable supply, weather issues out there in Pakistan, increasing import demand, at least in that market. But global production is still up year over year. So how do things pan out? How will tight export supply balance against lower demand? I think the market is still very much trying to figure that out. I think that market volatility can be expected to continue as the market tries to resolve these two competing forces. It seems like more recently, or at least in the recent weeks, that the market has been very sensitive to changes in macroeconomic news, particularly news from the Federal Reserve. I think has had an impact on cotton prices as it has had on stock prices. So I think that's something that will continue to move the market as we get further into the crop year. And as we start to see export sales starting to surface off of the new crop, we may potentially see some more cotton specific factors starting to affect the market. And those, of course, would tie in relatively closely with supply concerns if export demand proves to be robust. So those are my thoughts on the market. Hopefully you guys did make it through. I had enough caffeine dosage to get you through all those charts. I'll welcome any comments or questions that anybody might have.